Welcome to day 15 of managerial accounting. This is the official, once we finish class today, this is the official halfway point in the semester for this course. 15 out of the 30 classes, and this is the 14th instructional day out of 28 instructional days, as we have 2 days for each of the 14 chapters. So that's a pretty cool milestone, I think. As we look at the schedule for today, and this is I can't remember if I've told you, pointed this out to you, because this didn't really exist in this same way at the beginning of the semester. There's now this, under the table of contents, there's this course schedule button. It's been there for a couple weeks maybe, but I think this is a quick way to just see without having to pull up your syllabus or look at individual assignments. It has all of the due dates loaded in there on this course schedule. And so I'm happy to finally have something that I feel like I can display on the screen to start class that is comprehensive of everything that is due, regardless of whether it's in CNow or in Brightspace. And so you can see, looking at the course schedule, that the chapter 21 exercises are due today. By the end of the day, that means that you should be submitting them in CNow. At the end of class today, we will have covered the 4 remaining exercises for this chapter, but I know there are a few people here who were not here last week. So if you were not able to do those yet, remember that the first 6 exercises, you'll also want to complete those before you submit if you want full credit. So then our next class will be Tuesday, the 18th, and the chapter 21 problem would be due, as well as the chapter 22 pre-quiz, because we'll be starting chapter 22 on Tuesday. As we move ahead, then the chapter 22 exercises are due on Thursday of next week. But as we pointed out last week, chapter 21 is the 3rd and final chapter that's covered on exam 2. So as I look ahead to next week, I would like to schedule a review session for people who would want to attend in preparation for that exam 2. We'll talk more about the exam on Tuesday. We will look at the actual exam, look at the review set of exercises. And I guess just if you would like to be able to attend that review session, just send me an email to let me know maybe a couple of days and times that would work for you. A Tuesday or Thursday is not going to work based on my class schedule. As I explained to you a couple weeks ago now, starting yesterday, I have picked up a class that I had not had before. It was being instructed by someone else until the end of last week. And so at least for the foreseeable future, at least through Thanksgiving and possibly for the rest of the semester, I will have a Monday, Wednesday morning class, which impacts my office hours and impacts my availability for the review sessions as well. So I don't know who might be interested in attending those. I don't know if the one that we had for exam 1, it wasn't well attended. I don't know if that's because of the day and time it was scheduled, or if there's just not an interest in having that, whatever it is. If you would like to be able to attend, please just send me a note and let me know, if you had it at on this day or in this time frame, I could attend and I would like to be there. And to the extent that I get any of those emails, I will take those into account. I do need to get that scheduled, ideally today, but maybe tomorrow, so that people can plan around it for next week if they're planning to attend. But it could be really any day next week, because we're finishing the chapter today. So there won't be any new material introduced after today that will be on that exam. So let me know if you want to attend the review session, but you need me to schedule or try to schedule around your particular class and other activity schedule. Okay. Questions about any of that? Okay. So let me pull up this and do just a brief review of what we covered last Thursday. It has been a week, and again, there were a few people who were not here last week at all for this chapter. So chapter 21, the title is Variable Costing for Management Analysis. And I have on the screen just an example of absorption costing versus variable costing. Absorption costing is what is most familiar to you. This is the format that was introduced in financial accounting. It's the only one that we used in financial accounting because it's the only one that's acceptable under GAAP, generally accepted accounting principles. So that's what you see at the bottom of the screen right now, where the general format is sales minus cost of goods sold equals gross profit or gross margin. Then we subtract the operating expenses to get to our operating income. What we did last week, though, was introduced variable costing. And you'll notice that the operating income under variable costing for the same company can be different than it is under absorption costing. So that is different than what we did in the CVP analysis chapter when we talked about contribution margin. And we showed that the contribution, whether we use the contribution margin format or what we're now calling absorption costing, the traditional format, the bottom line was the same. It was just a regrouping of all of the expenses based on whether they're product or period for absorption costing or fixed or variable for the contribution margin format. Under variable costing, the idea is that we do not attach the fixed costs to the product. Let me restate that. Fixed costs are not considered to be a product cost. Instead, they are expensed in the period in which they are incurred. What that means is, under variable costing, there's no incentive to produce for inventory. You can't shift fixed costs off the income statement onto the balance sheet as an asset, inventory. And so it really does incentivize behavior that makes the company more efficient. You can see here, for this company, just as an example, they produced 15,000 units, but they only sold 12,000. Under variable costing, they still were hit on the income statement with all of the fixed manufacturing costs. But under absorption costing, the 3,000 units that went to ending inventory absorbed some of those fixed costs. And so it increased their asset inventory on the balance sheet. It also increased their operating income. The difference between this 40,000 and this 70,000 is the $30,000 worth of fixed costs, fixed manufacturing costs that were treated as a product cost under GAAP and therefore not expensed in the month in which they were sold. As inventory increased, some of those fixed costs were shifted to the balance sheet. That's the somewhat short summary of everything we talked about last class. We did the first 6 exercises to see what impact it would have if we sold more than we produced, if we produced more than what we sold. We did also discuss that if you produce and sell exactly the same quantity, there would not be a difference between variable costing and absorption costing. So any questions about where we are at this point? What those terms mean? Anything like that? Okay, so with this understanding of the concept of variable costing, we are going to turn to exercise 7 in chapter 21. And we're going to be looking at ways of using this understanding, not wanting to incentivize producing for inventory, wanting to reward efficiency, and how we can use that in a few different scenarios within that management decision-making framework that we've been talking about. So let's go to our first exercise for today. And that is exercise 7. Territory and product profitability analysis. We can collapse this and give us a little bit more white space, maybe if I need it. Coast to Coast Surfboards Incorporated manufactures and sells two styles of surfboards, Atlantic Wave and Pacific Pounder. These surfboards are sold in two regions, East Coast and West Coast. Information about the two surfboards is as follows. And so they give us all of that information about the contribution margin and how it's divided between variable cost of goods sold, variable selling expense. So we can see the manufacturing margin. That was a new term also last class. So manufacturing margin is sales minus variable cost of goods sold. Contribution margin, that term that was introduced in the CVP analysis chapter, is sales minus all of the variable costs, regardless of whether they're product or period costs. You can see, looking at that sales unit volume, that on the East Coast, only Atlantic Wave is sold. And on the West Coast, the sales are split between the two products. So before we move on to the actual requirements for this exercise, let's just take a moment to look at these data. You'll notice that the selling price of Atlantic Wave is much higher than Pacific Pounder, but almost all of that $80 increase in the revenue is eaten up by the excess cost. And so Atlantic Wave contributes $16 to the bottom line per unit, per surfboard, while Pacific Pounder contributes just a little bit less, $14 per unit, but that's on a much lower sales price. And so we may not get into this in the actual requirements for this exercise, but I always want you to be thinking about what that might tell you as a management decision maker, trying to make a decision about what to do for this company. So the Atlantic Wave costs significantly more, a high percentage more than Pacific Pounder. So if you understand about the law of demand, that all else equal, higher price, lower volume, right? We are willing and able to buy less of something when it's more expensive. I don't know, my assumption is Atlantic Wave is a better surfboard, right? That it costs more, the product cost is significantly more. So maybe it's made of, I don't know, a better material, a more long lasting, maybe a lighter weight, if that's something that's valued in surfboards. So they're not exactly the same product, but as a decision maker for this company, any recommendation you might make about, yeah, they should sell more of this and less of that, you need to take into account that this is not a one-for-one exchange. Someone who is willing to pay $120 for the Pacific Pounder may not be willing to pay $200 for the other option. And so what we are asked to do in Part A is to prepare a contribution margin by sales territory report. So before we do any of the dollar calculations here, I just want to fill in our headings. So we know that the contribution margin format is sales less variable cost of goods sold to get to manufacturing margin. Then we subtract the variable selling expenses to get to our contribution margin. We just saw that on the, where was it? No, up here up here at the top in the given information, it's per unit. So our calculations for East Coast are going to be pretty straightforward because we only sell one product, 40,000 of the Atlantic Wave. The West Coast column is going to take two separate calculations because they sell 25,000 of each product. So let's go ahead with the East Coast calculations. We're going to be starting with the sales price, $200. If we sell 40,000 of those units, what would our total sales or total revenues be? $200 for 40,000 units. So $8 million in revenues for the East Coast. But as I said, for the West Coast, it's going to be a little bit more, excuse me, a little bit more complicated than that because we need to do separately the Atlantic, what's it called? Atlantic Wave and the Pacific Pounder. And so I'm going to suggest it's not purely coincidental, but as it would happen, even though they don't sell the same quantity of the products, their revenues are identical for the two divisions or two sales territories. Now our variable cost of goods sold, again, for the East Coast, that's going to be pretty straightforward. 40,000 surfboards. And the variable cost of goods sold for Atlantic Wave is $150 for a total of $6 million. This exercise does not specify whether to use negatives or not. If it helps you to remember, please feel free to put a negative in front of that variable cost of goods sold to remind you to subtract. Moving on then to the West Coast, 25,000 units at that same $150 in variable cost of goods sold. But for the Pacific Pounder, the variable cost of goods sold is only $90. And so keep in mind that the West Coast sold a total of 50,000 surfboards, while the East Coast sold only 40,000. But yet their, manufacturing margin is the same. Everybody good so far? For the variable selling expenses for the for the East Coast, we have 40,000 surfboards at $34 each. And that leaves a contribution margin for the East Coast of $740,000. Do the same calculation now for the West Coast. That's 60. And although they have the same manufacturing margin, they do not have the same contribution margin because the variable selling expense per unit is significantly higher, more than twice as much for the Atlantic Wave as for the Pacific Pounder. And so the finally then the contribution margin ratio is the contribution margin in dollars divided by the total sales. And it asks to round to 2 decimal places. That means 2 decimal places on the percent. Did I just plug that in wrong? Oh, whoops, I have a math error. Whoops. 640. 8% there. compared to 9.38% for the West Coast territory. And so this points out why it is important, why the variable cost question is important, because the East Coast sells fewer boards of the higher priced product. The sales are exactly the same, but the contribution margin is diminished for the East Coast because of that higher variable cost in total. Those notes off the screen so we can read what's next. What advice would you give to the management of coast-to-coast surfboards regarding the relative profitability of the two territories? So total contribution margin is what for the East Coast? Slightly lower, while the contribution margin ratio is slightly higher for the West Coast. This is because East Coast sells only Atlantic Wave, which have a, let's see which one's Atlantic Wave. Atlantic Wave has a slightly lower contribution margin ratio. So it's $16, which is higher dollar for dollar, higher in absolute terms, but as a percent of the sales price, it is lower. But a higher contribution margin per unit. In attempting to improve the company's profitability, it is, what do you think? Would it be beneficial to consider changing the sales mix? Just based on what we have here? It's hard to know. This is an opinion question, but unfortunately, they're going to mark it correct or incorrect. I'm not a fan of that approach to say what advice would you give as if there's only one answer. But changing the mix of products to the two territories may not have much effect because of what we've just discussed. The contribution margin ratio per unit is higher for the more expensive board, but the ratio is lower. In addition, the variable selling expenses per unit for the Atlantic Wave, that's the $34 one, right? Yeah. Atlantic Wave may be too high. So why does it cost more than twice as much per unit to sell the Atlantic Wave than it does the Pacific Pounder? And the assumption is that these costs are constant across the country. And so on the West Coast, they sell a 50-50 sales mix. Why is it that they're spending so much more effort in terms of dollars, so much more to sell that Atlantic Wave? Is it because it's more expensive, so it takes more marketing? Or is, we don't know, but these are the kinds of things that you would think about, conjecture, and look into if you were a sales manager for this company. If you were trying to take this information and say, what could we do to improve the situation? Why is it that the Atlantic Wave only gives us $8 per, or 8 cents. 8 cents per dollar in sales in contribution margin, but the other product, what's the 14 divided by 120? But the Pacific Pounder contributes close to 12%, 12 cents on the dollar in contribution margin. why is the Atlantic Wave so much more expensive in terms of cost of production, cost of sales? Okay, so in this class, we can't answer that question, but you should be able to pose those questions. And if you work for this company, you'd be trying to find the answer. Who would you be talking to? Maybe sales and marketing. Why are we spending so much selling that product? Why does it cost so much more? Maybe we're talking to the production folks to find out, is there any way we can trim some of that variable cost of goods sold for the Atlantic Wave? It's almost 70% more expensive than the Pacific Pounder. Is that really necessary? Is it that much better? And another question that you might be asking, this might sound counterintuitive based on what we've already said, maybe the Atlantic Wave is underpriced. Maybe we should be charging a higher price for that, recognizing if we raise the price, it might impact our sales. Any questions about how we might use this information? Let's keep going then. So this exercise is quite comprehensive, as you can see. There is a lot to it. It goes over even a little bit farther. Maybe I can make that tiny bit smaller so it will fit on the screen. So there is a lot to this exercise, and we're not going to do the entire thing together, but we are going to do the entire thing during class time. So I'm going to introduce it. We're going to go down, we're going to do a couple columns together, but once you get the first couple columns, the calculations, the approach that you take is the same for each one of the columns. So let's take a look. This is a contribution margin by segment. The marketing segment sales for Caterpillar Inc. And this CAT, does anyone know what that is? Why it says cat in parentheses like that? Does anyone know what that means? Why they have that there? Anyone know what that means? CAT is the trading symbol for Caterpillar. So I believe they're traded on the New York Stock Exchange, and that is the trading symbol. So if you were watching a Market Watch kind of show, where you can see the ticker running at the bottom of the screen showing various stock prices for a variety of companies, blue chip companies such as Caterpillar, or high movement companies that are seeing a lot of fluctuation in their price would show up there. And they're listed by their trading symbol. So most companies, the trading symbol is 3 letters, but there are some that are 2 and some that are 4. I have this vague feeling there might even be a company that has just a 1-letter trading symbol, although I can't tell you what that is. But all publicly traded companies have a trading symbol that's usually 2 to 4 letters. That is usually an abbreviation. So like Google's, even though the company's name is Alphabet Inc., their trading symbol is GOOG because they're known as Google. I bet a lot of people don't know that the company's name isn't actually Google. So the company formerly known as Facebook, which is now known as Meta, whatever, their trading symbol, I believe, is FB, but I'm not 100% sure. But it's not Meta. So their trading symbol is something that is a shortened version of the name of the company usually, or how they're known. So anyway, CAT, these are actual numbers from Caterpillar. I don't know what year, but these are real data from an actual company, which we do not always have in our exercises. So they give us some information. They give us the sales number. You'll notice these are in millions, but we're only going to be using the numbers that are provided here. We're not putting in the zeros for the millions, but it is important to note that. You'll want to keep that in mind when you're working on your project, as that's upcoming here, that you need to pay attention to the labeling on your company's financial statements, because I guarantee none of them is reporting in dollars. They're all going to be reporting in thousands or in millions, more likely millions for the larger size companies that you've chosen for your project. It then gives us some additional information about variable cost of goods sold as a percent of sales, dealer commissions as a percent of sales, their variable promotion expenses, which are in millions. And we are asked to create a contribution margin by segment. So this column, this first column, is basically the same that the same thing that we did, the same format that we used in the previous exercise. So let's look at building construction products. And if I remember, it might even be that, let me see here. Okay, they are in order. I have this vague feeling that there might be something that was listed out of order in one of these places. We'll be careful about that. Nope, they're all the same. Okay. So let's start with building construction products. We can see their sales up there on the top row. That would be $2,217,000,000 in sales in the building construction products. Variable cost of goods sold is 45% of that. So 2217 times 45%. And we're asked to round these to 2 decimal places, except the contribution margin ratio, which is the bottom line. Our manufacturing margin, we know, is the sales minus variable cost of goods sold. Please be careful about rounding to 2 decimal places. If you start down a column and you're not rounding properly, of course, it's going to mark that wrong and you'll have to recalculate the entire column. Dealer commissions are 9% of sales. And variable promotion expenses, $310 million. So we're going to add those 2 lines together to get the variable selling expenses. And then subtract that from the manufacturing margin to find the contribution margin. And then the last step is the contribution margin ratio, which is that contribution margin divided by sales. And again, we're rounding this to 1 decimal place on the percent. Everyone feel comfortable with that approach? Anyone who has questions about that? Okay. So I think maybe just to be helpful, I'm going to put some signs in here. So we're subtracting there. These 2 we're adding to get that total. And then we're subtracting that to get the contribution margin. So the biggest thing to remember is to subtract the variable selling expense total from the manufacturing margin to get the contribution margin ratio. And then divide that by sales. Make sure you get your rounding correctly. 2 decimal places on everything except the contribution margin ratio, which is just 1 decimal place. So if there aren't any questions about that, I'm going to pause the recording and give you a several minutes this will take to finish up this part of the exercise. Okay, so I finished filling in all of the rest of those columns. Again, the format, the calculations follow the same pattern for each column. So I assume that if you got one, you got the rest of them, and that if there is a mistake, it's probably just either a typo math error or a rounding error on the percentages. Okay, moving on then. We're next asked to prepare a table showing the manufacturing margin, and we're going to be using some of the information from the previous table. So contribution margin ratio, for example, I can see right across the bottom of the previous table. I'm just pulling those data in, exact numbers. The manufacturing margin, so we have the manufacturing margin as a dollar amount, and we need to express that as a percent. So that would be as a percent of sales. Tells us that right here. Express them as a percent of sales for each segment. So starting with the building construction products, manufacturing margin was 1219.35. Divide that by the sales of 2217, and that percentage would be 55. We're asked to round that to 1 decimal place. Dealer commissions were given as a percent up here. So you can actually copy this row directly into the table below. So 9, 11, 8, 8. And the variable promotion expenses were given as a dollar amount. So we will need to convert those to a percentage in the same way that we did the manufacturing margin. Take the dollar amount. So for building construction products, that's 310. Divide by the sales of 2217. Round to 1 decimal place. And so 2 of the rows are already filled in for you, and you need to fill in the remaining 2 rows using the data that are provided in the table A. I'm going to pause the recording and allow you to finish up those 2 rows, manufacturing margin and variable promotion expenses as a percent of sales. Okay, so I just restarted the recording because I just realized that we're actually almost given the manufacturing margin as a percent of sales. So we're given the variable cost of goods sold as a percent of sales. The manufacturing margin would be the complement to that. So if variable cost of goods sold for building construction products is 45%, that leaves 55% for the manufacturing margin. So there's actually a much faster and easier way to calculate this first row. It's simply 1 minus the percentage that's given here. So you may want to use that, save yourself a little bit of time. Okay, so I have filled in the remaining 2 rows, and let's just take a look at those values. As we look across the contribution margin ratio line, we see that there's a little bit of variation. The lowest is 24.2, and it looks like the highest is 32%. Most of them are in the 28 to 32%, and there's just one that falls below that 28%. And it's a significant difference. CAT Japan is at 24.2%. So why is that so much lower than all of the other segments? Well, the manufacturing margin is lower, which means that as a percent of sales, their variable cost of goods sold is pretty high. They're actually the lowest manufacturing margin, electric power being the closest and a full percentage point higher. Their dealer commissions are also the highest across the board. So some of the dealer commissions are as low as 5 and 6%, but CAT Japan is paying 11% dealer commission. So that's pretty high as well. And the next line there is variable promotion expenses, and that does seem to be in line, more in the middle of the pack. Those range from a low of 7 to a high of 14% across all of the segments. So 9.8 is actually in the lower end of that and certainly comfortably in the middle of the pack. So to answer that question C, all of the following are contributing reasons that CAT Japan has the poorest performing segment, except, and the answer then would be the variable promotion expenses are not the highest. They're actually right in the middle. So the other two, variable cost of goods sold, dealer commissions, both right up there, the highest of all of the segments. Okay, so hopefully we've got green check marks across the board. Don't have any math errors, rounding errors in there. Any questions about, again, how we can use this concept of manufacturing margin and variable costing to maybe analyze our companies and hopefully make some decisions that lead to more efficient and therefore more profitable businesses? If there aren't any questions, we'll keep going. So as I told you at the end of class last time, our next exercises, and I think it's actually the next two exercises, are both related to how can we use this concept for a company that's not a manufacturing company. And so in our last two exercises, we're going to be looking at how we can use variable costing for a service company. So obviously the considerations here for a service company are a little bit different because as we discussed at the beginning of class, as we summarized what we did last class, so the basic difference is how we treat those fixed manufacturing costs. At least that's the difference between variable and absorption costing. But if you're a service company, you don't have manufacturing costs. By definition, you're not manufacturing. You're selling a service, not a product. But we can still recognize the difference between costs that are fixed and costs that are variable and how that makes a difference in our bottom line as our sales increase and decrease. So in general, we know that fixed costs are going to remain constant regardless of our level of activity or the amount of production that we are doing, while our variable costs are going to go up when we produce more or sell more, go down when we produce and sell less. And so that's what we're going to see in exercise 9, variable costing income statement for a service company. East Coast Railroad Company transports commodities among 3 routes. These are city pairs, so these are end-to-end transport. Atlanta to Baltimore, Baltimore to Pittsburgh, and Pittsburgh to Atlanta. Significant costs, their cost behavior and activity rates for April are as follows. So we can see that the first 4 items listed there are listed as variable cost. And so we have an activity rate already calculated for us based on the expected usage. And so those are per level of activity, per rail car, per train mile, per rail car. And the final 2 costs are listed as fixed costs. So again, that doesn't mean it's the same all the time, but what it does mean is it's a predictable cost and it doesn't go up and down as our level of activity changes. We then have some operating statistics there. train miles for each one of the three routes into total number of rail cars, and then revenue per rail car. We are asked to prepare a contribution margin by route report for East Coast Railroad. So of the three routes, the three city pairs that we provide transportation between these pairs, we're trying to figure out which of these might be more or less profitable than the others. And then we'll answer a question about what we found here in Part B. So let's start with our revenues. And we're given in the table that's right at the top of my screen now, we are given the revenue per rail car and the number of rail cars that transported between that city pair. So for Atlanta to Baltimore, we had 425 rail cars at $600 each, total of $255,000 in revenue. Let me make this a little bigger. For Baltimore to Pittsburgh, we had 2,160 rail cars at $275 each, total of $594,000 in revenues. And for Pittsburgh to Atlanta, 1,232 rail cars at $440 each. Adding across, we will have our total revenues for the period. Moving on, then we have our variable costs, and we have labor costs for loading and unloading rail cars. That's $46 per rail car. So we're simply going to be multiplying that $46 per rail car times the number of rail cars for each of the three routes. And then totaling across. It does tell us, it doesn't say anything about negatives in this part of the table, but it does tell us to use a minus sign to indicate a negative contribution margin. So we'll keep that in mind when we get down there. But you are welcome, if it helps you, you are welcome to put negative signs in front of each one of the variable costs, or use a negative sign in front of the total variable costs, again, to remind you to subtract. For the fuel costs, we have $12.40 per train mile. $12.40 per train mile. And the train miles are given in the table that's right at the top of my screen now. So each one of those train miles times $12.40. And add across. Then we have the train crew labor costs, again, based on train miles, and that would be $7.20 variable. $7.20 times the train miles given in the table at the top of the screen. Add across to get the total there. And our last variable cost is the switchyard labor cost, which is again based on rail car, $31 per rail car. So $31 per rail car for the switching yard times 425 rail cars for Baltimore to Atlanta. Last step, next step for this table, you're going to add down the column to get your total variable cost for each route. And then subtract that from the total revenues. And remember to show the contribution margin as a negative if the total variable cost exceed the revenues. Oops. And the last row, now that I scroll down, is going to be that contribution margin in dollars divided by the total revenues. Remember to show it as a negative if appropriate. Any questions about the numbers that we have in that table? So I think this is a really interesting comparison. It really points out why it's important to dive into the details of the company. Because if they just looked at the totals without looking at the city pairs individually, without looking at those segments or the routes in this case, you just look at the total column and it appears that they're doing okay. I don't know what their fixed costs are. I mean, we do know because they're up here somewhere. So we do know what their fixed costs are, but in this analysis, we didn't include that. And so it looks like, you know, we've got a pretty hefty contribution margin there. Nice contribution margin ratio of 26.6%. And so, you know, we might be happy right there. But once we start teasing apart the details and looking at these in a more deliberate way, you'll notice that the Baltimore-Pittsburgh route is highly profitable, and the Atlanta-Baltimore route is actually costing us money. So let's fill in the answers to part B, but then there's another question we might want to talk about. So which route performs significantly worse than do the other two routes? That's clearly the Atlanta-Baltimore route. Close examination of the operating statistics indicates that this route runs, I need to go back to so compared to the other two, it runs significantly fewer rail cars, very few rail cars, combined with fairly high. So it has the medium, the middle of the three in terms of train miles, but not very many rail cars per train, it appears. So combined with fairly high total mileage. This combination suggests that the railroad is running many short trains on the railroad. That is, the railroad's profitability is very sensitive to the size or length of the train in rail car terms. And so if you're this company, think about some recommendations. Now that we know this, now that we've looked at the details and we can see, hey, Atlanta, Baltimore is not terribly profitable. It's actually costing us money. We're not even bringing in enough revenue to cover the variable cost. What kind of recommendations could come out of this? What might you tell the company? Feel free to throw out any suggestion you might have for them. Brainstorming. Doesn't have to be a right answer. What's the first thing that jumps to mind? If you have a route that's unprofitable, what might you need to do? This is true for any product or service that you're selling. If you're losing money on it, what might you recommend? What do you think? So something's got to change. One option would be stop selling that product or service. In this case, that would mean stop running the route from Atlanta to Baltimore. Okay. So that seems very reasonable, except we'd have to really look at, if we discontinue that route, are there customers that use, say, the Baltimore-Pittsburgh route, which is really profitable for us, that are going to say, if you can't handle all of our business, you know, we want you to take stuff from Baltimore to Pittsburgh and from Baltimore to Atlanta. And if you're not going to take the stuff to Atlanta, we're going to find another company who will run both routes for us. So we don't want to deal with having two different railway companies coming in to transport our product. So in the economic terms, I know we've been talking a lot about economics lately in this class, and I'm really okay with that, even though I know that many of you haven't yet or may not ever take economics here at JCC, because it is really important to keep in mind the impact of the decisions. You know, you're not making a decision for a business. You're not making that decision in a vacuum. Any decision you make could impact other parts of the business. And so I've just typed a word on the screen. In economics, we have a term, and that term is ceteris paribus. It's Latin. And what that means is all else equal. If everything else stays the same, here's what we would do. But in this context, it might be that if we just say, we're not going to run the Atlanta-Baltimore route anymore, it might be that we lose business on the other more profitable routes. And so overall, because it's a smaller route, overall, yes, we're losing money on the Atlanta-Baltimore route, but we're only losing $30,000 as far as contribution margin. And we're still contributing a total of $370,000 to the bottom line of this company. So if it's going to impact the other segments, like Baltimore-Pittsburgh, which is quite profitable, we might want to just keep running that Atlanta-Baltimore. And in business terms, we might call that a loss leader. That we're willing to take a little bit of a hit on that route because people want us running all three of these routes. Maybe some of our customers are demanding that we have all three, or they take their business elsewhere. So Prosper had said, we might not just need to change something. And one, probably the most drastic change is to just say, we're not doing that anymore. We're going to cut the Atlanta-Baltimore route. But what else could change? Well, our revenues are based on the number of rail cars. And the Atlanta-Baltimore route has the fewest number of rail cars. It's already the most expensive, but maybe we have to have some kind of a surcharge for transporting trains that are under a certain number of cars. And we might need to take that into account. In essence, what we'd be doing is raising the price. We've talked about this in the last chapter, that again, you can't raise the price in a vacuum. The law of demand tells us if we raise the price, people are going to buy less of it. And so we have to be very careful about that decision to, we're just going to raise the price. But it's something that needs to be considered. Of course, a third option would be, is there any place that we can trim costs here? Is there any place that we could save money? Hopefully it would affect all of the routes, but in particular, we're targeting the costs associated with the Atlanta-Baltimore route. Is there any way we can save money on any of those variable costs and make it more likely that it becomes a profitable route for us? And so as we finish up this exercise and move on to our final exercise for this chapter, I just want you to keep in mind that nothing happens in a vacuum. As we're looking at business decision making, these are very valuable tools for us, but there's much more to it. And so I'm filling in this table as we did here, or in the last exercise, those two tables, which just seemed excessively large. And I agree that there are just far too many columns there. Because if you can do 3 of them, you can do 10 of them, right? So it wasn't necessarily terribly helpful. But what I really want you to get out of this is not just how to plug the numbers into the calculation or into the tables or to the formulas, but it's the interpretation of that information that's really the most important part. Because in reality, many of the reports that we're preparing in this semester in particular, we're extracting these data from our accounting records and dumping it into a pre-existing format. It's highly unlikely that anyone is sitting here in 2022 with their TI-84 calculator, plugging numbers into the calculator and doing calculations. At the very least, we're using Excel spreadsheets, we're putting in formulas, and it's just producing the numbers for us. So it's not the number calculations that are the hard part, but it's what do we do with this? And that's what I really want you to be thinking about as the most important learning from this is not how do we get the number? Yes, I think it's important that you know where the numbers come from or what goes into them. But there's a reason that accounting isn't considered a math class, because it's not about finding the number. That's the first step. But the more important, the big picture is, yeah, but so what? What does this number mean? And how does it help us make business decisions and improve the efficiency, the effectiveness, the profitability of our company? Because everything we are doing this semester is for internal decision makers, people who work for the company, and they're trying to decide, is this good enough? How do we make it better? We're constantly looking for improvement. Continuous improvement is really a tenet of business. It's critical that you are constantly on the lookout for how can we make this better. Any questions at this point? Everybody's doing okay so far? Well, let's move on then to our final exercise for this chapter. And once again, we are applying what we've learned in this chapter about variable costing to a service company. So I'm going to ask you to complete this on your own, and I'm going to pause the recording, but we're given information about the number of students who were supposed to attend, how many actually, or sorry, got the columns in the wrong order, how many were supposed to attend or how many we built into the budget, compared with how many actually attended, how much we charged them, how many credit hours, costs per student, and this is a fixed cost for depreciation. And we're asked to prepare the variable costing income statement showing the contribution margin and operating income for the fall term. So I'm going to pause the recording here and let you work on this on your own. This should take you just a couple of minutes. So I made my screen a little bit bigger so my calculations don't line up any longer with the rows, but I'm just going to go through this. So the revenue was per credit hour, 60,450 credit hours. The actual revenue was $120. That doesn't match up with the planned revenue or the budgeted revenue of $135 per credit hour, but this is not what we call a pro forma, which is a budgeted financial statement. This is the actual income statement using variable costing for the fall term. Then registration and records was based on the number of enrolled students, $275 each for 4,500 actual students. Instructional costs based on credit hours, $64 actual cost per 60,450 hours. Add those together, we get our total variable costs. Again, you can use a negative here as long as it doesn't tell you not to, if that helps you to remember. Added those two variable costs to get the total, subtracted that from the revenue to get the contribution margin, then subtracted the fixed cost of depreciation to get the bottom line operating income for the semester. Green check marks in there. And that is the end of chapter 21. So any questions, comments? Again, this is the last chapter for exam 2, which has only 2 chapters. I pointed out on the syllabus, each one of the exams is worth the same amount. So the exams that have fewer chapters get a little bit more weight per chapter, should be a little bit easier exam, and that kind of helps with you balance out the more difficult exams with 4 chapters. Next week on Tuesday, we will look at the exam and talk about the practice set, and we will have a review session scheduled for sometime next week. So please send me an email if you're looking to attend but need to work around some other obligations like other classes, for example. All right, thank you for being here, and we'll see you on Tuesday.